Welcome to this little discussion on the setup for calendar put spreads. We're going to take a quick look at the structure, stock, and option criteria we might consider for applying the calendar put spread in our portfolio. This is a direct question from Fernando during last Friday's open forum Q&A session, where we had a little bit of subtle issue with the search results and the search criteria. We fixed all that, figured out the problem. So now what we're going to do is walk through the structure of a calendar put spread. Our basic structure is that we're going to sell a near-term expiration put option, which is at or slightly out of the money for the put, meaning right near or just a little bit below the current stock price. Then we're going to buy a higher strike put, which is in the money, further out in time. Calendars really have two forms. The diagonal spread, which we just discussed, selling a near-term at or out of the money put less than 30 days out in time. Buying a far-term in the money put, in this case, a couple of months out in time. Now this is done at a debit spread, and it creates a bearish strategy for bearish markets. The horizontal spread means the same strike spread. This is also a form of a calendar where we're still going to sell that near term at or near the stock price strike put option, less than 30 days out in time, and we're going to buy a farther out put with the same strike as the put that we sold. This is done at a much smaller debit and is more neutral than actually bearish. We want the stock to stay at the same price and not fluctuate too often with the horizontal spread. Well, we can use calls or puts for either one. We can talk about a diagonal put spread or a horizontal put spread. Is one really better than the other? Well, in the diagonal spread, it's sort of a bear put debit spread, but we're purchasing a higher priced put because it's farther out in time. But this gives time on our side to continue to manage the position, continue to sell against it, rather than just the static next expiration bear put vertical debit spread. Set up correctly, you can only lose to the upside if the stock moves up in price, opposite of your sentiment for the position. If it's set up correctly, you shouldn't have two break-evens. It can be used to get into a married put position, but that is not advised. We're going to cover that later on this week. The horizontal spreads, the same strike spreads, and personally, I'm not a fan. I know they have a great risk-reward, and they have a pretty wide upper to lower break even. But the horizontal structure, whether it's calls or puts, the same strike calendars have two ways to lose. Most investors who trade this position aren't entering the trade and just leaving it alone to the near-term expiration and then managing it. Success is based on management. Naturally, the stock is going to move, so you're going to have to roll or adjust the short option up or down, depending on the movement of the security, eventually changing it from a horizontal spread into a different form of a diagonal, or changing both options to create a different horizontal spread as the stock fluctuates up and down. It's labor intensive, but it can be a profitable structure. But for our focus today, we're just going to focus on the diagonal put spread. What criteria should we consider? Well, we discussed already this is a bearish strategy. So for the stock, we want a bearish security that is currently in a downtrend. If it's a stock rather than an ETF or index, we want to make sure it has weak fundamentals. And as with any strategy, buying a call, buying a put, credit spread, debit spread, or vertical spreads, same with the diagonal, we want to avoid earnings between now and the short option expiration because we don't want any unnecessary movements to swing too wildly where we could be at a near 70, 80, or 90% loss. Although high V in the short term can give us a high premium to sell against the option that we're buying further out in time, we also might want to avoid high implied volatility, as that usually means there's some event coming up that could cause the stock to fluctuate wildly. And that's not what we really want in this position. For the spread itself, the structure of the two options that we're using, we're going to set it up similar to the calendar call spread, which we've discussed before. The option that we're selling near term, at or slightly out of the money, we want to be less than 30 days out in time. We can use weekly options that are 5 days out, 10 days out in time, 2-week out or 3-week out options as well. But in general, we want to keep the selling option under 30 days to expiration. The FAR option that we're buying, what we typically want is that option to be far enough out in time to have at least 4 write cycles. What does that mean? That means technically I can write an option 4 times before we reach the FAR term expiration date. So if my near-term option, I'm selling a 30-day out put for my diagonal put spread, I'd want the long option to be at least 120 days out in time. If I'm selling a weekly that's 5 days out, I typically want to be 20, 25, maybe 30 days out in time to give myself at least 4 write cycles every week against that longer option. The option we're selling is going to be near term, at or just slightly out of the money to take advantage of the ATM bell curve. And my FAR option, I want to be a little bit in the money, maybe at least 5% or more. That's also going to depend on the stock and depending on the price that you can get for the different strikes. As we've talked about with the calendar call spread before, I want my debit to strike difference ratio to be less than 1, meaning that the net debit I pay into my calendar spread, I want to be less than the difference in the strike prices. I also want a delta ratio. This is the delta of the long option that I'm buying, that's further out in time and in the money, divided by the delta of the short option. I'm going to start off with at least a 1.6 delta ratio or greater, or a 1.8 delta ratio or greater. So as the stock moves in my direction, in the case of the calendar put, as it moves down, I should be gaining significantly more on the long option than I'm losing on the short option. In addition to that, we talked about avoiding high implied volatility, as that may lead to an upcoming event that may cause wild swings in our position. But in general, I'd like an IV ratio of greater than 1, the implied volatility of the sell option divided by the implied volatility of the long option. Recently, with certain market conditions, that's been difficult to find with the calendar call or the calendar put spread. As we came across the EAP, we got through the earnings, then we had the election, and we're still in the pandemic. So some options on some securities that are further out in time, 2, 3, 4 months out, still have a higher implied volatility than the near-term options on stocks that have already passed their earnings, but we're still dealing with the election, pretty much over now, and of course, we're still in the middle of the pandemic. But all that being said, let's take a look at the search and power options, compare the whys of these criteria as we mentioned, and discuss the other form of a diagonal spread that can be used, and possibly a little bit more. All right, so here we are taking a look at the power options screen. And to go through the search criteria, we're simply going to go into calendar put, and we're going to go into search. Now right away, once I click on search, we're going to see the default calendar put positions that match our default criteria down below. You see here we have some default settings for the initial values. That's a good way to get started with a diagonal put spread. There's also the same strike or horizontal spread search that you can use as default to meet your own criteria, change and adjust criteria to meet your personal needs. And there's even one here that's kind of looking at the weekly calendar puts as well. Now down below, as I mentioned, the criteria that we've set follows sort of the basic rules we just outlined. Our near-term expiration time frame, we're looking for 0 to 50, 0 to 30 days out in time, and the FAR option expiration, at least 150 days out. We don't want to pay more than a $20 debit. If you're looking for a smaller debit to pay into the spread, just change that value to be less than 10, for example, less than $5, whatever meets your personal needs. We're looking for a basic max return of 3%. And a downside protection, the premium we're collecting against the long option that we're paying for, of at least 5%. Want to be just a little bit out of the money or at the money here with our out of the money screen for the near option. And we're going to go in the money at least 5 or 6% as I mentioned, but we're going to keep the delta ratio that we want of at least 1.6 and keep the debit to strike difference ratio of less than 1. Now, if you wanted to look for specific option volume, open interest, you want to look for a specific implied volatility for your sell option or your buy option, just make the adjustments as necessary. What about the stock? Well, of course, for the technicals, we're looking for a stock trading under the 20-day moving average. We want to see a stock in a downtrend. And we're also going to be looking for a MACD, where the MACD is crossed below the signal line in a bearish trend for at least 3 days or more. And we mentioned some of the basic fundamentals where we're going to look for a stock price of greater than 10, just looking for normal price stocks. And we're going to avoid the earnings date between now and expiration. I may also add in an earnings per share growth of less than 0, looking for stocks that have shown negative earnings growth. So we're looking for something with weaker fundamentals in that case. All right, but let's take a look at our default view. And the screenshot I had showed earlier was from the Baxter position, Baxter International, currently trading at 75.29. And we see we can sell the 08 January 74.5 put for 205 and buy the May 85 put in the money by about 10 points from the current stock price of 75.29 for 11.90. This gives us a net debit of $9.30 with a potential return if assigned of about 26.5, 26.6% at January 8th expiration. The 205 we're collecting against the cost of 11.90 is 17.2%. So we're essentially collecting a 17.2% premium against the long in the money option we're buying. We see that we have the delta ratio we want of greater than 1.6, do have the implied volatility ratio we want as well, and the debit to strike difference ratio of less than 1. To explain what those mean, well, we've already talked about delta ratio and implied volatility ratio, but to explain why this debit to strike difference ratio is important and some of the other concepts as well, let's take a look at the profit and loss chart for the Baxter position. Just use the Edit More Information button and go to Profit and Loss Chart. Now here we see the basic view of the Baxter graph, and we're going to go ahead and use the scrubber here to increase the size a little bit. Let's get it about 10 points down and about 10 points up. Almost perfect. Now the key to remember with diagonal spreads, just a little bit tricky, is that the profit and loss that we're expecting and the max profit and loss for the position seen here on the graph occurs if the stock is trading right at the short option strike price at the short option expiration. So in our case, on the 8th of January, if Baxter is trading right at 74.50, we'll expect a max profit of around 218, 219, 220, between about 22 to 23%. That return is based on the theoretical value of the long option using the Black-Scholes pricing model if the stock is trading at any of these prices at expiration. But if the stock's trading right at 74.50 on or around January 8th expiration, this profit of 219 is based on the theoretical value of our long option. The short option would essentially expire worthless. We could sell to close the long and make that double-digit return. Now, let's just clear this up a little bit and talk about some of the main reasons for our criteria. Now, we're just going to take this out. We're going to go a little shorter term to the under 30 days I had mentioned. We're going to go, let's just say, to the December 11th series, 16 days out in time. And we're going to sell the 75 put, which is right at the money, for a premium of about $1.50 against our 85 strike for May expiration. All right, so now we've got a 10-point spread, but we've got a debit of $10.20. It costs us $11.70 to purchase the 85 put. And we're selling the 75 put for $1.50. This means our debit is $10.20, but our difference in strike prices is only 10 points between 75 to 85. Notice what that gives us. It gives us a lower break even for a chance to lose a small amount if the stock drops below 65.90, and that upper break even of 76.60. The reason why in any calendar spread, calendar call or calendar put, that we screen specifically for that debit to strike difference ratio to be less than 1 is because we don't want to see the two break evens. If the stock continues to fall in price, we want this to stay at a profit. It is going to trail off of the max profit, of course, because at expiration, our short option delta is going to go either to 0 or to 1. If it's in the money, that delta is going to get close to 1, so for every dollar the stock continues to fall, we're losing 1 point exactly to our short put. Meanwhile, the long put is only gaining at a delta of 0.8, 0.85. Even though it's deeper in the money, it hasn't hit that expiration magic delta of 0 or 1 yet, so we lose a little bit more as the stock continues to fall at expiration. That's why we see the peak occur right at the short option strike price. But this here, although it doesn't look that bad, but this here is the reason why, when doing the diagonal spreads, I always want the debit to strike difference ratio to be less than 1. So I don't have an upper and a lower break even for my bearish position. Probably get a better premium going another week or so out in time. So let's just quickly go to the December 18th cycle, 23 days out in time. Keep the 75 put, but here, 155 to 210, we might get a good midpoint of $1.80, maybe $1.75, and that would put us where we want to be. So let's use the 18th December expiration against the May expiration, keeping a 10-point spread. We'll just use a midpoint of 180. Give us 30 cents more. So now, excellent. We don't see, let's use the scrubber again there, we don't see two break evens. Yes, it gets closer to 0 as we go on, as we talked about, because our short option will be getting closer to the delta of 1. But again, we just have the one chance to lose on this position, which is what we want with any diagonal spread. Got a reasonable return of 14.4%, not as high as the 22 or 23% we saw with the January 8 series, but this is still a good structure that would likely match our criteria for the trade. Now, earlier, I had mentioned that the diagonal spread, and I had a little asterisk next to this, is that what we want to do is sell the at the money. This is the structure that Fernando was asking about, shorter term, and buy an in the money, higher strike put, farther out in time. Some investors like to reverse this and use look for sort of what I should say, a calendar credit, meaning that I'd sell the same short option, but rather than buying an in-the-money put a few months out in time, I'd buy an out-of-the-money put, maybe a 65 strike put for May, to get a credit and to have maybe a better risk-reward. Well, first, you don't just do that with the puts. Okay, if I'm looking for a bearish strategy, remember, I'm using the calendar puts because I likely have a bearish sentiment. So if I just switch the 85 May put and add in the 65 strike put, midpoint of maybe about 205 or 210. All right, this gives us a midpoint of 215. And as we scroll down here, we say, okay, well, this one does have an upper break even as well, but what did we just do? No, we wouldn't do this with the strategy we initially looked at. This is not a parity trade. This is the opposite. We've actually created sort of a bullish position in this case, haven't we? That's not what we wanted. We wanted the bearish position. So what the parity trade would be naturally, for the diagonal calendar put we were just viewing, would be the calendar call done at a credit. So rather than buying an in-the-money call, I'm going to be buying an out-of-the-money call, the 85 strike, and selling the at-the-money 75 call for the same expirations. Let's take a quick look at that parity trade. December 18th, 75 strike call. May, 85 strike call. There she is. Okay, let's just use our midpoints here and see what we get. We're still going to sell the near term, 75, same as the put that we did, and buy the far term, but now we're using an at the money call and an out of the money call further out in time. We're going to collect about $1.90 at midpoint for the 75 call and pay $1.55 for the short. What does that mean? Hey, we're getting a net credit of 35 cents. But since this is an opposite structure, since the call option is now a lower strike than our long option that we bought, we've got to put up the margin requirement because this looks like a credit spread to our broker. We could be assigned on the short call at 75, the stock's anywhere between 75 and 85, and not exercise the long because it's out of the money, right? So just like a bear call credit spread, we'd have to put up the monetary requirement to cover the difference in the strike prices. Now, yes, we still have a max profit that's about 17.3%. We have the similar risk-reward profile to the calendar put spread. We receive a credit up front, but the cost overall, because you'd have to have the money on hold in your account, even though you took in a credit, is about the same. The max profit and the return is about the same. Yes, they're close to parity trades. One disadvantage of this position, set up in the structure that we're looking at, is at the start, the short call here is in the money, not out of the money as our short put was. Yes, if the stock falls, it would eventually be out of the money. But if the stock wavers around the 75, 76 price and we're short the 75 call, remember, we can be assigned at any time. Because the May option is out of the money, it wouldn't be exercised to cover that obligation. We may end up being short shares of stock at the $75 strike. Again, that might be okay because you're bearish on the position, but remember, you're trading this structure to not be involved with shorting the stock or being long the stock as well. That was your main game plan. So in this case, it does carry that slightly extra risk, and the monetary requirement, even though you're receiving a credit, you've got to put up that monetary requirement to cover the difference in strike prices because this looks like a credit spread, even though it's in a calendar form. So sometimes it's better to stay with the calendar put because the protection is already in place rather than trying to use the opposite, this credit calendar call position, simply because of the extra risk of being assigned early and not having the coverage unless the stock's above 85. And then, hey, in that case, both positions are losing pretty bad. We are wrong on our sentiment by a lot. But in any case, that's sort of what we're looking for on these positions. That's what we look for in the calendar put spread and the diagonal put structure. We want to be selling at, just slightly out of the money on the short put, under 30 days, and buying in the money. At least 4 right cycles or more out in time. Keep the debit to strike difference ratio less than 1. Keep your delta ratio of greater than 1.6, 1.8 if you want to be a little bit more conservative. And of course, if possible, like to see that IV ratio, the IV of the near option divided by the IV of the long option to be greater than 1. All right. Well, that's just sort of the basic review that we wanted to cover for Fernando that we didn't get a chance to on Friday regarding the diagonal calendar put spread. We have defaults set, as you saw, to meet the basic structure, the initial values for the calendar diagonal put spread, the same strike spread for the calendar horizontal spread, and there's even a default there for weekly calendar puts looking, 2 to 10 days out in time for the short option and about 40 days out in time for the long option. The defaults that we talked about are set for both calendar put and calendar call, diagonal or horizontal, but we have to remember something about these bearish positions especially, and weekly positions that have that shorter term strike and that lower premium. They are very subject to market shifts. If I'm doing the weekly calendar put spread or even the standard diagonal calendar put spread and the market's up 3% or 4% during that week, I'm probably going to be at a 30 to 40% loss. If it's the longer term one, I won't be that high, but it's going to be very subjective to market conditions. It should only be used in a bearish structure, Not even really neutral to bearish, just that you're more bearish on the market as a whole or the underlying security. Of course, the default criteria are designed just to give you a stepping stone. You can change those criteria, as we talked about, any way you want to meet your needs for this strategy in your two portfolios. There's absolutely nothing wrong with a credit diagonal, don't get me wrong. It's always a great idea in any strategy you're trading to compare the parity trades. The debit diagonal that we saw here, the 18th of December, 75 put on Baxter, combined with the 21st May 85 put we were buying, showed us a debit of about 985 with a max return if the stock was trading right at $75 on December 18th expiration, about $146 or so, about a 14.9% return. When I ran that parity trade earlier, I saw that the 18th of December 75 call, compared with buying the May 85 out of the money call, had a net credit of 5 cents, different than we just looked at in real time. But I have to put up the $1,000 to cover the difference in strike prices because this looks like a credit spread. So essentially I'm risking $9.95, but based on the pricing models, if the stock is trading right at 75 at expiration, because we took in that credit and the value of the long call, we might have a slightly higher return, $155, $154, or 15.5% return. The advantage I feel with the true diagonal, entering it as the debit diagonal for the calendar put spread, is that my coverage is in place. I don't have to put up any additional monetary requirement, and I don't have to worry about being assigned early, where I would with this credit calendar, the opposite or parity trade, because if the short calls in the money and I get assigned, it's anywhere between 75 to 85, I can't exercise the long to deliver the obligation of the short. I'm going to end up being short shares of stock. I'll have to close that out or do something else. It's unlikely my broker would never exercise that long 85 unless the stock was trading above it. So that's something to consider. If it's between the strikes on the calendar put, not doing as great as we hoped, but again, the short put is still out of the money. Our long put is still retaining time value and some intrinsic value. We don't have to worry about early assignment in the case of the debit diagonal for the calendar put or the calendar call. You can always check out other webinars on the calendar subjects. Just go to www.powerup.com/webinars.asp. Click on the Option Strategies tab, and you can scroll through there to find any information on calendar spread criteria, calendar spread basics, both for the calendar call and the calendar put. In addition to that, you can go to the YouTube channel. You can go to our YouTube channel. You can go to YouTube and look up Power Options. And on the Power Options channel, you can just search for content related to calendar. You'll see other topics on calendar call spreads, calendar put spreads, and more. Now, if you have any other questions or thoughts, of course, on this presentation, you can send me an email to support@powerup.com. Hey, of course, you can comment down below here on the YouTube video as well. We check those on a daily basis. You can also call the office during market hours at 302-992-7971. And remember, Power Options subscribers and trial members, you can schedule a coaching session at any time. Well, thank you again for watching this presentation. I hope you enjoyed it and look forward for more presentations coming soon related to that hint I mentioned a little bit about, is it a good idea to use a calendar put spread where we may potentially end up buying shares of stock if the stock's below our short put strike price and we get assigned early? Is this a good way to get into a married put position? It's not. We'll cover that a little bit more soon. Until then, take care. Happy trading.